Assalamu alaikum. This is our lecture number 14 of Global Business Management. The topic that we are going to discuss today is the foreign exchange market. The learning objectives are as follows. To appreciate the role of the foreign exchange market in ensuring against foreign exchange risk. This is the first learning objective. The next one is be familiar with the economic theories of exchange rate determination. And the third learning objective is role of macroeconomic indicators in determining exchange rate. Okay, last lecture was also related to the foreign exchange market. Foreign exchange market, we had discussed about the basic definitions of the foreign exchange market. And foreign exchange market is used to convert the currency of one country into a currency of another country. This is the basic purpose of foreign exchange market, and it provides, and the second purpose of foreign exchange market is to provide some insurance against foreign exchange risk, the adverse consequences of the unpredictable changes in the exchange rate. It protects the deals, it protects the companies, it protects the individual from unpredicted movement between the exchange rates, between the currencies. The exchange rate is the rate at which one currency is converted into another. This is the basic definition of the exchange rate. Okay, international companies use exchange market when there are four scenarios when international companies use the exchange rate. The first one is the payment when they receive for exports, the income they receive from the foreign investments, or the income they receive from licensing agreements with foreign firms or in foreign currencies. This is the first scenario when a firm is going to pay back some, is going to receive some payment in terms of if they had done export, if they had done some investment in foreign country, if they have some licensing agreement and they have to receive some income from money from the foreign market against the licensing. In all these scenarios, these companies have to receive some foreign currency, foreign reserve, and they have to interact with the foreign exchange market. This is the first scenario. The second scenario is when they have to pay, that companies pay again, if that company is going to buy some products from the foreign market, of course that company has to pay back that amount in that foreign currency. This is the second scenario when they are going to paying back some money into the foreign country, firm of the foreign country. The third one is if they have some extra money and they wish to invest in foreign countries. For instance, interest rates are high. For instance, take a scenario that when interest rate, a company has some extra money and they want to spend somewhere for a short period of time. The one scenario is they can use that money in their home country and invest somewhere, or put that money in the bank. And they are giving some percentage, for instance. And imagine a scenario that that company consider this, that if that money is invested in another country, of course another country they have to, and that opportunity will yield a better output, it give you high return. What gonna happen? That company have to convert this money into the foreign currency, and then they are going to invest there. This is the third scenario when they are making some investment in foreign country for a shorter period of time. Okay, the fourth one is they are involved in currency speculation. What is speculation? The short-term movement of funds from one currency to another in a hope of profiting from shifts in exchange rate. For a shorter period of time they have some money and they want to invest in a way that like we observe this thing in Pakistan as well. People, when they see this thing, when they anticipate that the Pakistani currency is going up or down, or dollar or euro, other foreign currencies are going up or down against the Pakistani rupee, they buy or sell that currency. For instance, we have seen this thing that the US dollar, the huge fluctuation we have seen in the US dollar in the last few months, like 5-6 months ago. We have seen this thing, the dollar increased from 90 rupees to it went to 112 rupees. And this people who foresee this thing, they made a lot of money because of this currency speculation. They could predict this thing money is going up, and they bought the US dollars, and they sold this US dollars at highest rate. During this buying and selling, they are making the profit. Okay, the foreign exchange market provides insurance to protect against foreign exchange risk. The possibility that unpredicted changes in future exchange rate will have adverse consequences of the firm. Of course, like we had discussed, that the exchange rate risk, because companies or individuals are not aware what's going to happen and how the currency exchange rate will be in the future. So there will be a huge consequences, severe consequences for the companies and individual. In order to avoid a control or protect themselves from that adverse effects, this foreign exchange market provides some facilities. A firm that ensures its the important that facility that if this foreign exchange market provides to protect the people or companies from this sort of uncertainty is called hedging. What is the meaning of hedging? To ensure or hedge against a possible adverse foreign exchange rate movement, firms engage in forward exchanges. This is the important point. That this in hedging, what they do, hedging means they use two parties agree to exchange currency and execute the deal at some specific date in the future using a forward exchange rate. What they do, these two companies, when they make some transaction, they decide about future forward exchange rate. They decide a forward exchange rate. That's the important thing. And rather than just leave that thing, we had discussed this thing that if a company A, there is a company A and they want to spend, they imported some stuff from some Pakistani company, they imported some stuff from USA and they want to pay money end of the month, but they don't know what will be the rate with the US dollar, and what they can do, they can collectively, they can decide about that I'm going to pay you with the forward exchange rate, and they can decide about that forward exchange rate. Forward exchange rate mean after 30 days rate is quoted on 30 days rate or 80 days or 180 days, 30 days, 90 days or 180 days period. Mean forward exchange rate, what's the benefit of forward exchange rate is you fix some rate after what you know about that after 30 days this will be the rate, after 180 days this will be the rate. No uncertainty, no risk. The next one is the spot exchange rate, is a rate at which, okay, we should understand the difference between the current rate and the forward rate. Current rate is called spot rate, but the spot rate at which a foreign exchange dealers converts one currency into another currency on a particular day or time. If you go now and buy some dollars against your Pakistani rupees with Pakistani rupees, that will be the money that you are going to get. The rate that you are going to get for that US dollar will be the spot rate, spot exchange rate. And the spot rate changes continually depending on the supply and demand of that currency and other currency. This is the important thing. The spot rate changes every minute, and how and who changes these things, the rate. It is determined by the demand and supply of these currencies. If the demand of dollar will be high, the rate will go up. If the demand of dollar is low, the rate will go down. That's how, this is the supply and demand basic principle. Forward exchange rate is a rate used for hedging in the forward market, like we discussed, and is typically quoted for 30, 90, and 180 days into the future. Another technique that we use in the foreign exchange market is the currency swap. Currency swap is a simultaneous purchase and sale of a given amount of foreign exchange for two different value dates. We had discussed the example of Brazilian and American firm. Brazilian and American firm, how Brazilian, if there is a Brazilian US firm want to operate some business in Brazil, and Brazilian firm wants to expand its business in USA. What they can do, the Brazilian firm can raise the money in USA because they need dollars, and they are already operating in the USA. But the problem is, in USA the rate of interest will be higher for Brazilian company because they don't belong to there, and the information asymmetry is higher for between the banks and the Brazilian subsidiary. What they can do, and the same scenario is for the US firm. US firm who is operating in the Brazil, is the rate of exchange is higher for rate of interest is higher for the US firm in Brazil, and the reason is same, is information asymmetry between the lender and the borrower. And what they can do, that US firm they can borrow money from the USA, and because they can get at a cheaper rate in USA, and they can raise the money, the US firm borrow money in USA in dollars at cheaper rate, as compared to if they go to the Brazil and borrow the money from the Brazil, it will be a higher rate. And Brazilian firm, they can raise the money from Brazil in their home currency. What they do later on, they can go to the swap bank and they can swap their currencies with each other, because the Brazilian company needs dollar and American company needs Brazilian currency. So in the end they can swap their loans. Okay, the swaps are transacted between the international business and their banks, between banks, and between governments when it is desirable to move out of one currency into another for a limited period without incurring foreign exchange rate risk. The foreign exchange market is a global network of being. Foreign exchange market is composed of the banks, bankers, and foreign exchange dealers connected by electronic communication systems. If exchange rate quoted in different markets were not essentially the same, there would be an opportunity of arbitrage. The process of buying a currency low and selling it high is called arbitrage. This is the basic definition of the arbitrage. The dealers always in search of, and they are looking for this arbitrage. They are saying this thing, if the for instance Pakistani rupees versus the rate of Pakistani rupee with US dollar is not same, it's not aligned in London and in New York, for instance. So what they're gonna do, they're gonna buy from one market and sell in another market and make a profit. This is called arbitrage. The last point, that the important thing that we had discussed, that the US dollar, the importance of the US dollar is used as the vehicle currency, because and 87% of all the currencies in the world are done in US dollars. How are exchange rate are determined? This is the very important point, and we all are really concerned, or we have the question that how these exchange rates are determined even in the Pakistan. Why sometimes the rate of Pakistani rupees go down, and sometimes which is very seldom, it go up against the US dollars. There are three factors which really impact on exchange rate movement. The first factor is the country's price inflation. The second factor is the country's interest rate. The third factor is the market psychology. But before we see these points, there is a basic fundamental thing. What are these all these economic books or economics thought say is that rate of exchange market between the two currency is determined by supply and demand of that currency. If the demand of that currency is high, the rate will go up, and if the supply is more and demand is not, in a way we say that if the demand exceeds the supply, rate will go up. If the supply exceeds the demand, rate will go down. This is the basic principle they say to determine the exchange rate between two currencies. But on the other hand, there are scholars who predict that this supply and demand cannot explain the rate of exchange between the two currencies. Rather than currencies, price, inflation, macroeconomic variables are more important in determining the currency exchange rate. We will see first of all the price inflation, how a price inflation influence the exchange rate. This is the first thing that we are going to see, is the law of one price. There is one notion which is considered as law of one price, which states that in competitive markets free of transportation cost and barriers of trade, identical products sold in different countries must sell for the same price when their price is expressed in terms of the same currency. They are saying this thing, the law of one price. This is the first concept. According to this concept, that in a competitive, but there is some supposition for this concept. The supposition is there is no transportation cost and there is no trade barriers between the countries. When these this position, we fulfill this position, then this notion states that if we buy a product from Pakistan, the rate would be same in USA. Like in jacket price in US should be the same in Pakistan. I mean, in a way that, for instance, if we buy a jacket in Pakistan, and if we go to the USA and convert Pakistani rupees into USA, the price would be the same. Like for instance, this book, or we can say that one shirt. If the one shirt is the cost of one shirt is 500 rupees in Pakistan, that shirt should be, if we consider the rate $1 is equal to 100 rupees, that shirt cost should be at the cost of $5. This is called law of one price, and its position is transportation cost and barriers to trades are non-existent. This concept, the law of one price, leads to another concept which is called purchasing power parity theory. Purchasing power parity argues that given relatively efficient market, now the law of one price leads to the purchasing power parity concepts. We will discuss it later, but important thing is the law of one price has the assumption of efficient market, most efficient market where we don't have the transportation cost, we don't have the trade barriers. But purchasing power parity has the assumption of relatively efficient market. A relatively efficient market means there are certain barriers which is more closer to the real world, this supposition. Markets in which few impediments to international trade and investment exist. Okay, and this is in reality we have a lot of impediments, a lot of obstacles in international trade. Okay, purchasing power parity, which is based on relatively efficient markets, it says that the price of one basket of goods should be roughly equivalent in each country. The same concept we talk about the jacket in law of one price. The purchasing power parity is same. The purchasing power parity mean the purchasing power of people should be the same across the globe. Important thing is, rather than jacket, the basket of goods which is more necessary for for the basic needs of living. These basic things should be same, or basic some food elements, they should be same across the countries. And the famous thing they say, the price of one Big Mac should be the same in Pakistan and in USA. When we convert Pakistani rupees into the USA, it should be the same. It predicts that changes in relative prices will result in the changes in exchange rate. The basic theory, this purchasing power parity, says that if we observe that the prices of these products are not same across the countries, that's mean exchange rate, mean it will affect on the exchange rate, and it will determine the exchange rate. This is the prediction of the purchasing power parity. Like it's saying in this way that, like, if we talk about the Big Mac, if the price of Big Mac is 200 rupees in Pakistan, the price of that Big Mac should be the $2. Like on the other way around, if we say that if the price of Big Mac in USA is $2, it should be here of 200 rupees. But if we don't have the 200 rupees here, if we have 300 rupees, that means this difference from 200 to 300 will change the exchange rate between the Pakistani rupees and US dollars. This is the basic theme of purchasing power parity. So using the simplest example, okay, we talk about the basic example. Our basket of goods is a Big Mac. Like we should be able to buy a Big Mac in New York and then take the same amount of money, convert into the yen, and buy a Big Mac in Japan, or convert the money to pounds and buy a Big Mac in London, and so on. But important thing is, when we convert that US dollar to yen or pound, we should be able to buy from exactly that amount of pound. We should be able to buy a Big Mac from that amount of pounds. If you cannot buy from that amount of pounds in London, then that means you know that one of the currencies is undervalued or overvalued. This is the basic thing. Which will mean if it's undervalued or overvalued, of course the currency exchange rate will be changed. Okay, how do prices influence okay, if we see this, like the first thing is the price inflation, country's price inflation. And we did talk about the influence, how do prices influence exchange rate, and we did discuss the example of Big Mac. Now we talk about, we are going back, now we are talking about a positive relation. We are continue with the same thing, with the price, with the impact of prices on stock exchange rate, with the exchange rate, between the currency exchange rate. Okay, there is a positive relationship between the inflation rate and the level of money supply. How there is a positive relationship between the inflation rate and the level of money supply? When the growth of money supply is greater than the growth of output, inflation will occur. Okay, this is the basic. Start with the second point. Second point says that when the growth of money supply is greater than the growth of output. What does it mean? It means that imagine a scenario, everybody got a note, हर किसी के हाथ में पैसे हैं, but when they go to the shops, there are no products available there in a similar frequency, in a similar level. Mean increase the level of or degree of increase of money in the market is higher than the supply of goods. That should be compatible, that should be in line with each other. If the supply of good is lower than the supply of money, then we go to the shop, we don't have the products at the same level. But what's going to happen? The demand of those products will be increased. okay, that when the demand of those products will be increased, like more people are willing to buy that product, then what going to happen? The prices will go up. The prices will go up mean inflation is high. It is inflation. So what does it mean? When the money supply is greater than the growth of outputs in the country, then inflation will occur. Okay, now go back to the point 1. The positive relation exists between the inflation rate and the level of money supply. Now we understand this first point. Okay, what the purchasing power parity suggests that changes in relative prices between the country will lead to exchange rate changes, at least in the short run. A country with the high inflation should see its current currency depreciate relative to other. Purchasing power parity suggests that changes in relative prices between the currency, like we say that, like we have seen this, the price of Big Mac is, you convert the dollar, and you should be able to buy, you convert the dollar into the Pakistani rupees, and you should be able to buy the Big Mac from that amount in Pakistan. If you cannot do that, that's mean there is Pakistani currency is overvalued or undervalued, and that will determine relative price between the country, and it will lead to exchange rate changes. Now it will be a change between the exchange rate, and this change will be important point is this change will be only exist in short run. It will not be in the long term. Why? A country with the high inflation should see its currency depreciate relative to others. Important thing is, when you are going to see this thing that you cannot buy a Big Mac with 200 rupees, which you could buy with the Big Mac in US in $2, and you cannot buy the Big Mac in Pakistan with 200 rupees. What's going to happen? That's mean there is inflation, and your currency, Pakistani rupee, will depreciate with relative to US dollars. Okay, people have tested the academics, the scholars, these studies, empirical studies have tested the prediction of PPP, and suggest that this theory, the prediction of this theory is working good only in short term, and that is most accurate in the long term. And for the countries with the high, okay, this theory, the prediction of this theory is accurate, is good even in long term for those countries where inflation is higher, underdeveloping countries, and for countries with the high inflation, the underdeveloped countries suggest more accurate in the long term, and for countries with the high inflation and underdeveloped capital markets. This PPP theory is accurate in long term, and the countries with the high inflation and the developing countries mostly they have the high inflation, and for the developing countries having the high inflation, the prediction of PPP is accurate in those markets. Okay. If we talk about, if we consider an example, if a government suddenly decide to give everyone 10,000 US dollars in an increase in the money, what's going to happen? An increase in the money supply, this is called. Many people would use the money to buy more clothes, furniture, and other stuff. The increased demand would encourage stores and other providers of goods to raise the prices, which of course is inflation. The increased supply of currency in the economy would then cause the value of a currency to drop. Okay, what's the flow of these activities? First of all, supply of money is increased. What's going to happen with this thing? The demand of goods is increased. Because of demand is increased, but the supply is not at the same level, it's not at par. Because of demand is increased, inflation is increased. Because inflation is increased, buying power is decreased. Buying power of each people is decreased, and because the buying power is decreased according to the PPP, the currency should be depreciated against that main currency. Okay, does PPP work in short run? There are several reasons why the theory isn't accurate in the short run, including the fact that that it assumes away transportation costs and trade barrier, doesn't consider the power of multinational companies to influence prices, control distribution channels, and differentiate their products, and theory does not consider government intervention in the foreign exchange market. Now the studies predict that they have tested, like we had discussed, that these studies have tested the prediction of the PPP, and they say that there are a lot of scenarios, situations, or market where the prediction of the PPP is not valid. Why? Because then these studies suggest that because PPP is not considering the realities of the existing world, and this PPP is ignoring the transportation cost, trade barriers between the countries, and it's not considering the power of multinational enterprises to influence prices of these goods and control distribution channels and to differentiate their products, and they do not consider the government involvement in the foreign exchange market. These are the factors which are absent from the PPP predictions. Okay, now we are going to the next point. The first we discussed about the price, how prices effect on exchange rate. Now we are going to talk about how interest rate affect on exchange rate. In countries where the inflation is higher, like we had discussed already, how the supply of money increased, supply of money is increased, demand of goods is increased, demand will increase, the prices will go up. Prices will go up, that mean exchange rate prices will go up, will mean the obvious mean is inflation is high. When inflation is high, that means the currency will go down, the currency will depreciate. Okay, now they talk about the inflation. We didn't talk about the inflation, about the interest rate yet, but we know about the supply of money. Increase in supply of money leads to increase in inflation. It is already established. In countries where inflation is high, inflation is expected to be high, interest rate also will be high, because investor wants compensation for the decline in the value of their money. In nutshell, what is saying, when the inflation is high, interest rate will be higher as well. How? Because the investors who have invested the money, they are going to demand higher interest rate, higher return on their investments, and because of higher investments, the interest rate would be higher. This is basic simple understandable notion. Okay, this relationship is formalized between the inflation and interest rate, both towards upward. This one is higher, the interest rate will go up. This relationship is determined or formalized by the Irwin Fisher and is known as Fisher effect. The Fisher explicitly formally states that country's nominal exchange rate is a sum of required rate of interest, and expected rate of inflation over the period of time. Nominal exchange rate is a sum of real rate of interest and expected rate of inflation over the period of time, R plus I. Okay, totally understandable. Okay, later on, this relationship is tested in the international market, and the Fisher suggested that for any two countries, the spot exchange rate should be changed in an equal amount, but in opposite direction to the difference in nominal interest rate between the two countries. Mean, if there is a difference between the interest rate of two countries, okay, then the difference will lead to the change in spot rate as well. But in the opposite direction. If the difference is towards the positive way, the spot rate will go down. it's upward, then this spot rate will be on the downward. In mathematical form, it's written like this, that S1 minus S2 divided by S2 multiplied by 100 is equal to IS dollar and the yuan, I yuan, where IS and I yuan are the respective nominal interest rate in two countries. In the case of US and Japan, S1 is the spot exchange rate at the beginning of the period, S2 is the spot rate at the end of the period. Countries where inflation is expected to be high, interest rate will be higher as well. We have already discussed it. In order to encourage investors to keep their money in the market, countries are the governments are forced to increase the interest rate. Otherwise, the investor will go somewhere else. If there are no restriction on capital flow, real interest rate must be the same everywhere, or an arbitrage situation will exist. In other words, if the real interest rate in France was 10% and in US the real interest rate 6%, investor would borrow cheap dollars to invest in France, and this would bring the value of a dollar up. The consequently push the real interest rate in the US up. The opposite would occur in France. So the international Fisher effect, that if now there is a hypothetical situation that there is no restriction on the capital flow and the interest rate is same everywhere. If there is no restriction on trade barriers in the international market, then interest rate, the real interest rate should be the same. If the interest rate, for instance, is this one, in this example here we are talking about if the real interest rate in France is 10% and in USA is 6%, what's gonna happen? People immediately rush to the USA and they start borrowing money from the USA, because they are getting the cheaper they are getting the money at a cheaper rate, and they raise the money from the USA and they're going to invest in France. This would bring the value of a dollar up, because the demand of dollar is high, because they are providing the cheaper rate, the demand is higher, and because the demand is high, the interest rate will go up. Interest rate will go up, and in France people are spending more US dollars they are raising the money from the US and investing in the France. The supply of dollar in France is higher. Because supply is higher, the rate will go down. In USA, because of before it was like this, in USA it was 6%, in France it was 10%. People start borrowing money from here and investing here, and what's going to happen? Demand is increased, demand is low, because people were borrowing from here, and dollar is in more demand, and here they are investing, because that means the supply of dollar is more. What's going to happen? Because of demand, it will go up, and because of the high supply, demand will go down, the interest rate will go down, and eventually it will come to the same level, same rate. And that's why I say that it should be optimally, it should be at the same across the market. The real interest rate should be the same across the countries. Again, it's a hypothetical situation, and hypothetical mean there is no trade barriers, no restrictions, and this and that, no government invention, and this and that. Okay, so this is called international Fisher effect. State that for any two countries, the spot exchange rate should change an equal amount, but in opposite direction to the difference in nominal interest rate between the two countries. Okay, now we had discussed first of all prices, how prices affects on the exchange rate. In the next one we had discussed the interest rate, how interest rate affects on the exchange rate. Now the third point we are going to see is how market psychology or investor psychology affects on exchange rate. In investor psychology, we are going to talk about the most important concept is the bandwagon effect. What is the meaning of bandwagon effect? Is it occurs when the expectation on the part of traders turn into the self-fulfilling prophecies traders can join the bandwagon and move exchange rate based on a group expectation. Okay, how mean in late term, if we talk like this, that bandwagon effect, how it happened, the one guy, they predict something and all of other guys following them, like वो जो भीड़ चाल नहीं है वो है ये. I mean, one guy said that this one is go up, this price will go up, and everybody immediately start buying that thing. And we see this is not, I mean, in reality, bandwagon effect is not only occurs in the stock market, this exchange rate market, it occurs in everywhere. I mean, this is the psychological phenomena, and we see it in consumer. This is concept related to the consumer psychology. Government intervention can prevent the bandwagon from starting, but it is not always effective. We saw this happen in 1992 when George Soros, a well-known international financier, made a huge bet against the British pound. He borrowed billions of pounds and sold them for government marks, for German marks. This helped push down the value of a pound on foreign exchange market, and many other investors jumped on the bandwagon and sold pounds as well. Okay, mean, like we have seen this thing that because of this bandwagon, what this one is saying, that George Soros, a famous stock marketeer, what happened that a huge bet on against the British pound. He predicted that British pound will go down against the German mark, and he borrowed billions of pounds and sold them in the German mark. And later, all the other person, they observed him, and they started to follow him, and they joined the bandwagon and sold pounds as well. George Soros, a currency speculator, wreaked havoc on the Thai baht in 1997. His actions, followed by others, is a typical example of the aforesaid bandwagon effect. Incidentally, because of this, the Thai baht lost more than 50% of value against the US dollar. Because of this thing, this is not only the good thing, or this is not only the good for everybody. This guy, he made the speculation for the Thai baht in 1997 that this one will go down, and people start selling this Thai baht, and what happened that because everybody, whoever got this Thai baht as a foreign exchange, they start selling this thing. People, companies who invested in Thai baht, who invested in Thailand, they start selling their investment, and they were moving away from Thai baht. What happened? And all the investment went they disappear from, or they say that because of this thing, that people were selling this Thai baht. Because of the selling, the supply of Thai baht so increased in the market. When the supply of Thai baht increased, that means currency will go down. And it's in 1997, it sees that in the Thai baht lost more than 50% of its value against the US dollar because of this thing. People who especially who were from the USA, the big investors or big companies, they pull back their investment in Thailand. And because of this pullback, it's not only related with this bandwagon effect, is not only relevant with the individual people, this also, companies are also following these things, because companies who are running these companies, the people, the managers, these CEOs, these CFOs, these people are managing these companies, or they have this sort of psychology, they are influenced from the other people. If one company is they're putting back the money, the other company might do the same thing, and this will be some chain reaction, and all the investors pull back their money from the Thailand, and the overall value went down 50%. Okay, this is the one case study about South Korea, how South Korea, the currency crisis started in South Korea. And this is why did the Korean won collapse. In this case study, again, exactly like a Thai baht, same happened here. in this Korean case, that in 1997 South Korea could look back its pride in 30 years economic miracle, but that had raised the country from the rank of the poor and given it to the world's 11th largest economy. Okay, South Korea's lost industrial conglomerate Chaobal during 1990. Chaobal is considered as business groups which are very famous in the South Korea. Okay, as the volume of investment ballooned during the 90s, the quality of many of these investments declined significantly. The investment too often were based on the projection about the future demand conditions that were unrealistic. This resulted in significant excess capacity and falling prices. An example is the investment made by the Korean Chaebol is in semiconductor factories. Investment in such facilities surged in 1994 and 95 when a temporary global shortage of dynamic random access memory chips led to a sharp price increase for this product. However, in 1996 supply shortage had disappeared and excess capacity was beginning to make itself felt just as the South Koreans started to bring new DRAM, these RAM chips factories on stream. The results were predictable. Prices for DRAM plunged through the floor and the earnings of South Korean DRAM manufacturers fell by 90%, which meant it was extremely difficult for them to make scheduled payment on the debt they had taken on build the extra capacities. Important thing is, before the financial crisis, it was like this, that there was a temporary shortage of the RAM, these microchips, which are used in the computer production. And who are the main producers? The South Korean firms were the main producers of these chips. And what they did in the early 90s, when they see this thing that there was a shortage of RAM, and they installed new factories. They borrowed the loan from the governments, and they borrowed the loan from the foreign countries and in the foreign currency, and they install new production units, production facilities of these microchips. And they made a lot of money in 1994, 95. They made a lot of money, but later on, when they gradually in the next subsequent years, when the demand of these microprocessor chips, it went down, demand decreased, the profit of these companies reduced to 90%. They fell by 90%. And what was the problem? Because these firms couldn't pay back the loans to the government, to the foreign companies. They were not able to pay back that loans, and the risk of corporate bankruptcy increased significantly. And it was the process occurring is just as the semiconductor industry. Semiconductor overall, the whole industry was sort of bankrupt. South Korean companies were also investing heavily in the range of the industry, including the automobiles and the steel. Much of the borrowing had been in the US dollars, as opposed to the Korean won. At the time, this may seem like a smart move. The dollar won exchange rate has been stable to 1 to 850 won. Interest rate for the dollar borrowing was different. The important thing is that the rate of exchange was between the whole transaction, the whole borrowing of these companies were in the US dollars. Okay, because of this, in mid-1997, the foreign investor had become alarmed at the rising debt level of the South Korean companies, because when these companies were going bankrupt, government was borrowing more and more for the bailout, or for the bailout of these local domestic firms from the foreign countries in the US dollars. And the foreign investors, they were watching this thing, and they were alarmed with the high level of South Korean debt. South Korean company, particularly given the excess capacity plunging the prices and several, he made that the given increasing speculation that many companies would not be able to survive in their debt payment, foreign investors began to withdraw their money from the South Korean stock and bond market. This is the important thing. When the foreign investor, they observe this thing that now the government is backing or bailing out few companies, and a lot of companies, they went bankrupt. Now they stop investing in South Korean companies. They stop investing in the stock market and the bond market. The selling of won accelerated in mid-1997 when the two of the smaller chaebol filed for bankruptcy, citing their inability to meet scheduled debt payment. The increased supply of won and the increased demand for the US dollar pushed down the price of won from 840 to 900. And important thing is again the supply and demand concept, that when they see this thing that these firms were unable to pay the debt to the foreign debt, what was that thing, that the demand of dollar increased as compared, and when the demand is increased, the exchange rate of US dollar against the South Korean won increased from 840 to 900. Okay, this is the whole story, because this scenario escalate in the later months, and overall then later on the US, the World Bank had to jump in. In fact, the IMF had to jump into the South Korean situation, and they bailout package to the South Korea, and they survived the bankruptcy. But again, the basic and concept, if we see that how demand and supply or market situation or the investor psychology is involved in this sort of exchange rate or this sort of financial crisis. Important thing is all these factors, they can escalate and they can pile up together, and they can appear in the form of the whole collapse of the country's economy. Now we will talk about, since we have done this two or three topics today, and the last lecture was also related to this topic, foreign exchange market, and we can see a quick few questions about this review. These are the review questions. You can think about this question, and you can try to provide the answer of these questions. The first one is the filling the blank multiple choice question. Is the rate at which one currency is converted into the another, and you have the four choices: exchange rate, cross rate, conversion rate in the foreign exchange market. The next question is the rate at which a foreign exchange dealer converts one currency into another currency on a particular day is a currency swap rate, forward rate, specific rate, or spot rate. Which of the following does not impact future exchange rate movement? Currency price inflation, currency interest rate, country's arbitrage opportunities, and market psychology. These are four choices, and you have to think really hard which of the following does not impact future exchange rate movement. Okay, when a government of the country allow both residents and the non-resident to purchase limited amount of foreign currency with the domestic currency is called non-convertible, freely convertible, externally convertible, or internally convertible. Answer of these questions are available in the book, in the chapter, even in the slides. In this slide, answer of these questions are available. The extent to which a firm's future international earning power is affected by changes in exchange rate is called accounting exposure, translational exposure, transactional exposure, and economic exposure. These are the four choices you have that you can think about. What is the exact answer of this question? Now you can get the answer of these questions, all these review questions from the book, or these are available. But important thing which I really suggest is, first, without looking at the answer, you have to think about what can be the right answer. That's just sort of a practice. Okay, now we can talk about the summary of the lecture. Basically, we had discussed about the three forces which determine the exchange rate. The first one we did discuss about the price inflation. The second one is the interest rate. The third one is the market psychology. Before we started discussing these three things, the first one is the law of one price. We should understand what does it mean. The law of one price states that in a competitive market, free of transportation cost and barriers to trade, identical products sold in different countries must sell for the same price when their price is expressed in terms of the same currency. The thing that you are buying from one market, you should be able to buy with the same price in the other market. This is the basic concept of law of one price. And for instance, we discussed the jacket price in USA and USA is $5, and if we convert to the $5 to the Pakistani rupee, it's the 500 rupees, and we should be able to buy the similar jacket, or we should say the same jacket, with the 500 rupees in Pakistan. The next term we have seen is the purchasing power parity, which argues that the given relatively efficient market, which is based on purchasing power parity theory, is based on an efficient market, is a relatively efficient market. Relatively mean which have some market, which consider some market impediments in international trade. The price of a basket of goods should be roughly equivalent in each country. Mean a positive relationship exists between the inflation rate and the level of money supply. When a growth in money supply is greater than the growth of output, inflation will occur. The flow is like this. When the supply is increased, the demand of goods is increased, and important thing is demand is increased and they see this thing that the supply of goods are lower than the demand of that goods. Supply of money is increased, the demand of goods is increased. Of course, when they don't see the demand, when they don't see the products, the supply of products is low, the inflation increased. Inflation mean people have money but they cannot buy, mean their prices are going up. That's mean the purchasing power parity, buying power of the people are going down according to the PPP. And that's mean when the buying power is going down, that's mean currency rate is going to depreciate. This relationship is proposed by Irwin Fisher, and it is known as the Fisher effect. It states that country's nominal exchange rate is the sum of required rate of interest and the expected rate of inflation over the period of time. Another thing is that which is important is the international Fisher effect, which states that for any two countries, the spot exchange rate should change in an equal amount but in opposite direction to the differences in the nominal interest rate between the two countries. Important thing is real interest rate should be same, should be at par across the countries. We had discussed the example of US and France, that if the real interest rate in USA is 10% and the real interest rate in France is 6%, people start borrowing money from the France and invest in USA. That's how they're gonna do that, and until they will continue this behavior, this pattern, until the level of interest rate will get equal. Because when you see this thing that the level the demand of euro is increased in France because of the lower interest rate, the demand of euro is high in France. When the demand is high, the rate will starting to appreciate against the US dollar. It will starting to raise up. And on the other hand, people are investing in the USA. They are getting the money from the France and investing in the USA. What's happening? They in USA, the supply of euro is high. what's going on when the supply of euro, people are more investing there, supply of euro is high, the rate is going down, and here demand of euro is high, rate is going up. It will continue, this process up and down will continue until the both rate in both countries gets equal. Until that point, this process will continue. That's why hypothetically the International Fisher Effect states that the real interest rate should be same across the countries. Last thing that we had studied is the bandwagon effect. Bandwagon effect occurs when the expectation on the part of the traders turn into self-fulfilling prophecies. Traders can join the bandwagon and the move exchange rate based on the group expectations. Mean people on the basis of their expectation, they predict some rate and they predict some changes in the exchange rate, and then few people do that, few traders, few investors, they predict this thing, and the other people who might be, they cannot, they see or they don't foresee, but they join them, they join that move, and overall the people, the whole market start doing the same thing. And because of this behavior, this pattern, this pattern is considered as the effect what is caused is the bandwagon effect. And in the case study which you can do, which you can study again more thoroughly and think about how bandwagon effect affected on that the financial crisis in the South Korea, in Thailand, and how the value of Thai baht went down. It devalued to 50% as compared to in comparison with US dollars. And all this they're saying that especially for the Thai baht, the researchers claim that it was the negative effect of the bandwagon effect, and all the most credit of the Thai crisis goes to the bandwagon effect. In the next lecture we are going to talk about, most importantly, we will talk about the efficient market and inefficient market, and how these markets differentiate across the across the developing and developed countries, and what are the assumptions are behind these between the efficient and inefficient markets, and how the prices, the exchange rate are determined in efficient and inefficient markets. Thank you for today. Allah Hafiz.